negative volume index. Now the negative volume index is based on days where the volume decreases from the last day. The assumption is that institutional money takes position on days when volume is less than previous days. Now this is an important assumption. If you have traded with institutional investor, with hedge funds, with mutual funds, you would have seen firsthand that institutional investor or like hedge funds, they're not looking to buy the high. They're looking to buy the low. They are contrarian investors. Once the price is dropping, they are looking at it closely. Now when the price is dropping, the retail investor will automatically become sidelined. And the institutional investor will start to buy, start to come in. And they will start to average their rate at till a certain point. And then the price moves up. So this assumption of negative volume index is really important. The second assumption is that volume rises when retail or uninformed investors buy stock on rumors. Now, if you have traded markets, you would have known that there are many kinds of rumors coming in. And when you see price rising, you as a retail investor always try to jump into the bandwagon. Now, negative volume index knows this, and therefore it helps catch this assumption into the chart. So you as an investor, as a professional investor, will see this happening in the chart and will understand that if the chart is rising, then retail investors started to jump in. Because the price won't rise when the institutional investor will be accumulating. The price will stay within a certain band. But once institutional investor has filled his bucket and the retail investor jumps in, the price will start to get rising up again and again. And this is when you will see that the negative volume index rising up. So it tells you that the uninformed retail investor have started to jump in, either on rumors or by just seeing the stock price rising up. Therefore, NVI tells what institutional money is doing. So you as a retail investor have a really greatest weapon in your hand, understanding what the institutional money is doing. That's one of the biggest thing. Because if you know what the institutional investor is doing, then your trading will become safe. There is an old saying about NVI, that is 95% odds of success when NVI rises above 1 year's simple moving average. Now that accuracy is huge. And when we will discuss negative volume index on charts, I will show you this strategy and it will change your game for sure. Therefore, NVI is always used as a bull market indicator. A bull market indicator all the indicators is the crown jewel of indicators. Because if you can understand when there is a bull market, you can always multiply your money. Because how do you lose money? You just jump in and it's a bear market. The price falls off and you lose money. If you can understand that this is a bull market and you get in and the price rises up, then you always make money. The NVI was introduced in the magazine Stock Market Logic by Norman Fosback. Thank you.